with me here. Make sure it's up and doing what it's supposed to do. And then it's public too. Hey, Miss Donna, are you on? I know she had some stuff. Let me make sure she's on actually. To make sure. Donna, are you there? Can you manage YouTube?
Yes, I'm here.
And is it live? Is it public? I think so. Started streaming. I wanted to make sure because Lord knows I never really know what that's doing. But okay. Well,
hi, Jenny.
Hi, how are you? Who's this?
Isa.
Hi, Isa. How?
I'm good. Here from Sweden. It's late at night, but I have to catch 10 to listen.
Oh, well, then you got all my live music jamming out to that. Listen to that. See? I'm keeping you up, all kinds of up today. Welcome.
Tribute to Eddie Van Halen.
Yeah, Derek. All right, guys. So real quick, let's go ahead and just go over just the kind of disclaimer because we have to do that because Lord knows we don't know what we would do without that. So as you guys know, everything we discuss in this call or this class is considered to be educational purposes only, meaning it's all theory based, it's all educational based. Any signals that are given out in a live class or in a forum is considered to be educational and not necessarily trading or investing or financial advice. So anything said cannot be used against you in the court of law. We are not your financial advice or your legal advice of any kind. So there's your disclaimer. It's a high risk activity, potentially very profitable, but also very risky. So don't trade what you can't afford to lose. Pretty simple. Real quick, I put this in at the end of or the beginning of many of my calls, and I know I tend to talk a little fast, so I will slow down. But how do you compound an account seems to be the biggest thing that people get wrong. And that's just basically sticking with a set of rules that they can do over and over and over again, despite the plethora of information and YouTube videos and all the different try this and use this indicator and do this instead. But maybe sticking with one thing long enough to actually perfect it or to get good at it. So Bruce Lee had some quote that says, I never practiced 10,000 kicks. I practiced 10,000 kicks one time. One kick 10,000 times to become like that expert. So if you're going to become an expert in anything, you've got to stick with it long enough to, be proficient or technically proficient in any way. So this is what you do once you decide the strategy you're going to stick with. Your idea is to stay with that set of rules for at least 50 trades. And again, you're going to need multiple batches of 50 trades to get to the end of this, experiment, if you will, or to find out the profitability, to find out your niche, to find out what your edge is and how to improve it. But that's never going to work if you pop around to every new thing. So obviously, you need a plan in terms of rules, exit management, protection, trailing stops, all other good stuff. Trading plan should be exclusive to one account, one strategy, and a few pairs or specific pair, but it shouldn't be all 28 pairs and all 58 strategies. So should kind of be a little bit more exclusive. Have a schedule, obviously, and y'all can take a screenshot of that. So I'm going to, maybe stop my share. I got to move this screen now, actually. Move that, and I'm going to have to fix this, so bear with me. Just out of curiosity, can you guys still just see the template or can y'all see something else? Because it's never sure.
The template.
That's good to know. Thank you, Miss Barbara.
You're welcome.
Because there's been videos where I guess my whole desktop pops up and I had no idea. None.
We see your Beaver Fever posters in the back.
I have a beautiful mountainscape. Thank you. Beautiful mountainscape. I'm telling you. Okay, so now I'm on my VPS and I know that we have Mr. Rich on here and I'm just going to call him Mr. Italian or Mr. Rich or Mr. New York, but he is actually on here tonight to kind of go over some market, what did he call it again? Institutional levels. So I'm not going to take up a whole bunch of your time, but I am going to show you guys this right here. It took me a hot minute to get everything like it was supposed to be. Turned out I was the problem. Go figure. We discussed that and we joke about it. But to get the simplicity and the scanners and stuff working like it's supposed to be, you have to make sure you have the right codes and all that other stuff in here. I clearly did not. So that is neon green and painful to the eyes. Sorry, I didn't have time to really edit this template to my traditional, green and purple. But I wanted to show you guys, for all of those who caught it, I know a few of you did. Barbara, I was praying for you, man. I even logged into Telegram just to see. I could have swore you were going to post me a screenshot. I was waiting. I was hoping somebody else caught it, but that's okay. So we finally got that huge push down. We talked about it a couple of times. It's moved up quite a bit. I'm going to go back just to show you. that not necessarily to show off this system, but to show you people were selling this last week. And I'll kind of zoom out, make this a little ugly and go back. That we were trying to sell, and it did sell for a hot minute. Don't get us wrong, but we waited all morning for that, and that was stinking beautiful. And we talked about that this morning. It just didn't happen. We had to pop up first before we went down. Same thing that happened on NAS, which was stinking awesome. Anybody got a pip count on how much that moved? Because I'm dying to know altogether. I only caught a small portion, but the whole move was 3,000 pips, and that's NAS, not US 30. And that's in minutes, guys. That's a whole bunch. So I had to go over these real quick because I could not go over these, especially when we had spent, some of this didn't move nearly as much, but it did move. So the original, we had an entry in here. We took profit. Some of us got back in, but the whole move on that one was almost 2,000 pips. And this is worth almost 120%, give or take, of what US 30 is worth. So those are some pretty awesome moves. If you guys did not catch those, I really, really, really recommend you take a look at some of the scalping strategies. Go to a smaller time frame. If you're using the simplicity, you'll get a slightly earlier entry. Granted, this is set to a really late entry, so that's why you're getting it so late. It's not set early, it's set pretty late. But just to show you guys that, and we know that gold dropped exponentially. So I had to go over those because, well, some people lost their hats today, but some people also, earned a house today. So did anybody catch some of these moves? I mean, since some of y'all work with me, did anybody catch even a small portion of these moves? I'm dying to know. Since it was after hours, it was after we were trading in the morning. Somebody's got to speak up. I know Tammy said in the group, and a few other people said in the group. That's it.
I did not.
Donna's like, I did not. Fine. I know Barbara did not. She caught some of the buy, but she did not catch it either. So, all right. Well, I guess you guys will be shy. That's totally fine. I'll check my chat too, and then we will give it over to Rich real quick to see. Rich, are you on here? Coach Reed said he got a small portion. Jonathan said he did. Daniel's talking about Big Pasta, aka Mr. Rich. We can call him Big Pasta. I can totally change that. That'd be a funny YouTube name. So Big Pasta. So Steve, tonight what's going to be discussed is institutional levels. So I'm not sure where he's at just yet, but I'm kind of giving him a minute. He did message me, talked about an orzo recipe or an Italian recipe, essentially. Oh, I see him. He's at the top. He's on here. I know he's on here. Rich, are you there? Because we can't hear you. I see you're unmuted.
Yeah, I'm here.
There you go. Well, hi, how are you?
Good. What's going on?
Had to talk about these moves because you see this beautiful move on gold. Do you see what happened today?
Oh, yeah.
The whole world was trying to rebuy this thing, and we're like, nope, we're not going to keep buying it. Everyone's like, it's going to go to 2,000. It's going to go to 2,000. Nope.
Yeah, it was amazing. Yeah, I couldn't catch this because I was up and about today, but I caught the morning one, 3:30 in the morning, right where the J high is, all the way to the top there for it was like 200 something pips.
Not bad at all. That's a really good time. Yep, that was like 3:30 in the morning. So
Yes, that's me. I'm Mr. London, New York. So yeah.
you keep London. You totally keep London. So, all right. Well, then I guess if no one wants to speak up in terms of simplicity or even some of the scalping, they're all going to be in the chat hanging out. What I'm going to do is I'm going to go ahead and give you the floor. So I'm going to let you share your screen. Sound good?
Cool.
All right, cool. And I will retitle this video whatever you would like me to title it. But you're the boss. You're in charge.
Today we're gonna be discussing risk management.
Okay. There you go.
Yeah, definitely. I'm trying to keep this not too crazy. And let's see. So I'm going to let's start. So I'm gonna start pretty much with the whiteboard. So
Okay.
that way I can let's see if I can get that going. I want to try and.
Do you have control of the whiteboard? Just out of curiosity, I'm not sure. Or do I need to make you co-host, which means I'd have to steal it from Donna? Let's see, make co-host. No, I can make more than one people co-host. There we go. You're co-host now. So
Cool.
should have the whiteboard, right? Because I don't think you have it when you're a guest. I could be wrong, but
Let's see.
did anybody catch the GU trade that actually wants to speak up a little bit? Because I got several messages on that. The people who don't like trading the indices because they're too heavy, but they did catch GU. GU fell pretty hard too, as did several of the other GBP pairs. It just was the day. I mean, we can call it the federal chairman, you know, we can call it that. We can call it whatever we want. But at the end of the day, it was just a matter of waiting for the move to happen. And they're going to use whatever excuse they need to. So that's also a pretty move.
Yeah, today I think Trump spoke up and oh my God. Yeah, it was crazy. Let me know if you guys can see the whiteboard.
I can see it.
All right. What about the writing? Yes or no?
Infinity.
You're trying to tell us it's going to last forever.
Yeah. Yeah. All right. So like today, I've seen a lot of messages. I go through my messages periodically. Unfortunately, I can't do it every day, but sometimes I do go over it, and I kind of find a lot of disparity when it comes to everyone as far as risk management, especially amongst the new guys. I think that's something that really, like Uncle P says it a lot, but I don't think people listen. I don't think people understand. So I'm gonna kind of go over it really like in depth today. Like, I mean, a lot. Like, I'm gonna get into it where, I can explain it to you, and if you have questions, we can go over it. So this is the basis of my I guess class today. So it's going to be based on risk management, because I feel like a lot of people are taking way too much risk and over leveraging on everything. I can see it in the chats, especially when people lose, is when you kind of see how much they lost, because they say, well, I had like a standard and their account is only a couple $100. You have no business trading a standard on a couple $100.
That's right.
And then, yeah, I mean, and Uncle P says it all the time. I don't know if you've seen today's video. I love Uncle P. He's like, because of him is why I got into this to begin with. So, he said it today. He says, you might catch one trade at, like, for example, half a standard, like a 0.5, and then you'll catch another trade at a 0.3 and another one at a 0.5, and then you say, oh, I got this, and then you go up to that standard, and that's the one that you lose, and then all of a sudden you got no account left. So this is why we're kind of doing this today. So the basis as far as Forex, I would say, if you look at your account, right, let's just say, hypothetically speaking, we have $100 account, right? So if we have $100 account, if we divide this into 0.2%, right? So 0.02, this is ideally what you're looking to do. This is basically the reason why you do 0.02 is for survivability. And I know, especially if you got a small account like this, like this job club, like you have to work at this, so don't think like you're coming in here to quit your job tomorrow, because that's not happening. So survivability is probably one of the biggest things that, that keeps you successful in Forex. So by taking 2% of your account, that will actually give you survivability. I'm going to show you a formula today, which will allow you to make 3 trades, even if you fail more, and then downgrade it a little bit. Again, like if you look at this formula, $100 is not a lot, right? And a lot of us start with this. I know I did, because I was just testing the waters. I didn't want to put my whole $1,000 in there, but you know, it's not a lot. And as you'll see, the progression of this is very slow too. But once you get good at your strategy and your strategy works and you consistently do it, then at that increase the amount, not of your percentage, but this amount. You can increase the amount of dollars that you have in your account so that, you know, exponentially your 0.2 will increase also. So you never want to increase the 0.2. The 0.2 is a solid, you know, this is stationary. It doesn't move. It doesn't switch. Some people say, oh, well, I'll do 5%. But remember, at 5%, you're now down count very again, because there can be a string of losses. So even I've had a string of losses recently. I had 3 losses in a row where I was like, okay, what the heck? But again, like today was one of them, you know. I'm trading far less. For example, I used to have 23 trades in a week. That's a lot. You have no business making 23 trades. That's like crazy, you know. So I've learned, you know, as I've been going along. So this week I've only had 7 trades. So, and you know, today's what, Tuesday? So, you know, I've been, and that's because I look at multiple pairs and you know, like, but again, the reason I keep surviving this formula is what's going to get you, you know, your survivability. It's going to let you survive. So, you know, if we do the math, you know, like I said, this is not a lot. It's actually $2, right? So 0.2% of 100 is only $2. So what does this mean? Like, how am I supposed to incorporate this into when I'm trading? Does it mean I'm only going to make $2 bets? No. Remember, the next thing that comes into this and is very important is going to be your risk to reward. This is the most important. I'm not going to go very far. So this is not something that
Hey, sweetheart, real quick, I'm gonna.
That's why I don't really
Rich, can
like.
you hear me? Real quick, I'm
Scalping.
interrupting you. Sorry,
Take it.
I'm interrupting you. Is anybody else having problems? Like, is he breaking up, or is it just my computer that's breaking up?
Yeah, it's
No, it's
also a
breaking
problem.
up.
No,
Okay.
he's breaking
No.
up.
Yeah, it's breaking. Very laggy. Yeah, yeah.
Maybe
Okay.
check all your massive devices. I know we all have like 58 of them kind of running through our homes. Lord knows I do. So
Yeah, I
especially if I go live, maybe sign out of a couple of other devices, and that will clear up your voice a little bit so they can hear you. That's all. Sorry
Yep.
to interrupt you.
No worries, no worries. Yeah, you can't hear me. I mean, there's no, you know, definitely we gotta fix that. Let me know if there's a lag. Just interrupt me, all right? Just let me know right away. I just turned off 2 devices.
Jessica said you sound drunk, so just so you know. But we still love
Oh,
you.
I sound drunk. Well, that doesn't happen too often, but when it does, hey, hold on, let me double check.
Uh-huh.
Keep your shirt on. Oh, I thought he was taking his shirt off. I'll tell him. Keep it on. Keep it on.
Leave it to Derek to leave that, right? Drunk on pips, somebody said. Okay. Bro sounds drunk, but we still love you, Rich. For real.
All right. Yeah. How about now? How does that sound?
It sounds a little better. It's okay. They pick on me too. I get picked on 24/7. I think that's Derek's main job. So
Oh, yeah.
it's just part of being
Yes,
part
it
of the
is.
family.
In,
So
in California, we have Jimmy G. So in New York, you'll be Richie G.
there you go.
Yes.
And the fact
Yeah.
that in the past it sounded fine until it didn't. So
Yeah. But yeah, so, you know, like, as far as like risk to reward, this is where the big play is. You know, you've gotta do minimum of 1 to 2, and then what you're really looking for, your ideal risk to reward would be 1 to 3, and then plus. So you really wanna work on your risk to reward. So this is you know, this is like something that I've done myself, where I've taken $100 account, and then I actually brought it up to $500. So, you know, it wasn't easy, and it's not something you do in a week, you know, because remember your $2 here, right? This $2 here is something that will actually keep you alive. Like, I mean, if you look at how many trades you can do with this, you can do 50 trades. You know, you can always increase it a little bit. You know, like I always say, 3% is even acceptable. But 5%, I think, again, it's cutting it too short because 5%, again, you'll have less trades. So, you know, like, what does this $2 represent? Does it represent that I can only make a $2 trade and that's it? This actually represents your stop loss. So that's the risk to reward. That's kind of like what we're looking at. So the risk to reward is kind of like where the you know, that's what your stop loss represents. So if you look at how you're supposed to set this up, if you're using a 0.01, right, that's a 10 cents account. Remember, you have $2 as a risk. So basically, you have 20 pips stop loss. Does everybody get that?
Yes, sir.
Okay.
Yes.
Cool. All right. So this is exactly how we're going to figure this out. And I'm going to show you just a quick few examples of different accounts so it doesn't look so little, because I know that's a little account. Like most of us, you know, start there to test out the market. But this is what I want you to understand. This number is the most important number of the entire scheme. If you know, you can, again, like I said, you can do 3% too to make this $3, and then, you know, it'll be a little bit less. Like you have about 33 trades that you can lose before completely vanishing your account. So in essence, you know, I really stick to this because this is the only way that you can survive and keep your account alive. And even though you consistently lose, if you lose 6 trades out of 10, you're still going to be profitable. That's the beauty of Forex. You're still going to be profitable. So you can only win 4 trades out of 10 trades, and you're still going to be positive. You're going to be net positive. And why? Again, because the R&R that you're looking for, the risk to reward that you're looking for, is going to be 1 to 3 or greater. I'm going to quit a bunch of programs too. Hopefully that'll help as well. All right. So, example, $100 I know is not much, but I just wanted you to really understand where this $2 comes into play, because a lot of people $2, you know, loss maximum. So how the heck do I use that? So the maximum loss is $2. That means you have at a 0.1, you have a 20 pip stop loss. Now I've heard and I've seen people mention 50 pip stop losses and 40 pip stop losses, and why bother? I mean, you know, like if you have a 50 pip stop loss, your risk to reward drops. So if you had a 1 to 3, now you just dropped it down to a 1 to 2 by having such a big stop loss. So my methodology is, when I trade any currency except for GBP, right? GBPs and also gold, right? So gold and GBP, I have to put a higher stop loss because this darn thing moves like, you know, like a bat out of hell. It's like super fast. So yeah, 15 pip stop loss is not going to work there, but 15 pip stop loss is my normal stop loss. Now my strategy works with this perfectly. So I only put 15 pip stop losses. So if I get taken out, this wasn't correct, but then I watch it patiently, right? I'm not going to jump back in just because it moved, you know, it moved like 15 pips, took me out, moved another 5 pips, and then I see another down, you know, arrow, and I'm like, okay, good, I'm going to get in. No, that means that my analysis was incorrect, and I wait for the market to give me another setup, and I watch and make sure that, you know, what I'm looking for is there. For example, if I'm looking for a certain pattern to get in, to jump into, you know, I'm going to wait for that pattern. I'm not going to just jump in because it took me out. Oh, and then I get anxious. Oh, I just lost 15 pips. I got to make it back. No, you lost. Leave it alone for a second. Watch it. Maybe your analysis was incorrect and it's not ready to move downward yet. But, you know, once you see the pattern that fits your strategy that you're looking for, then you can go ahead and jump back in. And again, my pip stop loss would only be 15. For GBP and gold, that's a little bit different. For GBP and gold, I'm using about 25 pip stop loss. I don't use anything higher than that. Again, because my strategy allows me and affords me the ability to be able to, use the 25 pip stop loss maximum. If you're, look, guys, if you're using more than 25 pips stop loss, why bother? If you're losing 40 pips to make 40 pips, it doesn't make any sense. You know what I mean? It doesn't make any freaking sense. That means, your strategy is like a little bit off. You got to tweak it so you can have a tighter stop loss. That means you're catching the market off. So instead of waiting for the market to turn and give you a solid pattern that shows you an actual flip and then getting in, you're trying to get in when the market's still on movement. You know what I mean? So it's like saying don't catch a falling knife or something like that. I probably a Sicilian saying, but like, just you gotta be real careful with your strategy. If your strategy is not affording you a 15 pip stop loss for non-GBP gold pairs, if you're using more than that, guys, you got to tweak your analysis and you got to tweak your strategy. It's not working. You shouldn't have more than a 15 pip stop loss. That means you're just literally wasting time and money. So tweak your strategy, tweak the patterns that you use to jump in, because that means that it's just not what you're looking for. So all right, so let's move on a little bit. Does everybody understand how I got this 20 pip stop loss with this $2? A 0.01 with 20 pips is $2.
I do, but I'm going to interject real quick to acknowledge, like if you're trading a larger time frame and you're trading, for example, the day chart or the 4-hour chart, and you're going for hundreds of pips, having a larger stop loss is more applicable, number one. Number two, as much as we want to determine our risk based off of our appetite, right? Just like we want to eat, the cookies and the donuts and the ice cream based off of our appetite, we also sometimes have to deal with our environment, and our environment may not include those things. So like the environment of the market, you have to place your stop loss above or below structure. So if the trade is no good because the stop loss is too big, I would say that would make sense. And last but not least, seeing how I'm slowly but surely becoming the queen of indices, I feel like, yes, I'm going to pat myself on the back for just a half a second, feeling a little good. But the indices, I mean, you're talking hundreds and hundreds and hundreds of pips, right? That you have to have some room for. So I think that needs to be variable based off of the pairs you're trading and the time frames you're trading. And then you have to determine, your risk to reward. And then obviously not every currency pair is worth exactly $10 per pip. So they're all a little bit variable. That's not a USD pair. So I would just insert those 4 or 5 points and join in with you there. Sorry.
No, I got you. Yeah. So GBP and gold, right? They move so fast, and they kind of move similar to the indices, but obviously the indices give way to more, I would say more reward than GBP and gold can, right? Because even though GBP and gold are pretty quick movers, yeah, you're right. The indices like the US 300, my gosh, that thing moves like 1,000 pips in just minutes, So yeah, for the indices, you still use the same basis, but you've got to be careful because on the indices, I think the 0.01 is already $1 a pip.
It is, yeah.
So yeah, so you got to be careful how you break that down. Like again, so what in my strategy, right? I use a certain pattern, or I shouldn't say one. I have certain patterns that I look for because again, market makers, they know what we're up to. Everybody knows the tricks already. Everybody knows, that people study, market maker patterns, market maker, everything. So they always try to switch it up and kind of like hand us, a raw deal all the time. So, but there are multiple patterns that I've gotten used to, and I have a lot of what's called safety trades, where once they form a certain pattern and I'm not too sure that pattern is going to be the one I'm looking for, I wait for that retest of that certain pattern. I know I probably lose like a couple of hundred pips on that one, as far as like gold is concerned, but at least I know that my stop loss will be very well respected in that sense. So check your strategy, you know what I mean? And of course, the next thing is check yourself, because a lot of times, we are our own worst enemy. So that's the next thing I wanted to bring up. Like when you're doing this, 2% is what's going to keep you alive. And then, if you're not sure of something, don't get in. That's my basis now on how I do everything. If like, for example, EG, Euro GBP. My gosh, that thing has been, I don't know if you've seen it, it's done a lot of consolidating, right? And you know, this morning I was going to try and jump in, but then I looked at it and I said, I'm not sure, because based on what I was looking at before, when I'm looking left, it's like, oh my God, it's crazy. I don't want to get into that. So I said, you know what? I'm looking at it. I'm second guessing everything I'm saying. You know, like it's consolidating. It did a lot of this. And then it had a big spike, a big drop. And then again came here. I said, you know what? No, I'm not going to do this to myself. I stayed out of it. And guess what? Today, with the US news, that thing just, it spiked the other way. It took out so many people. Like it was crazy. Like I was like, I'm glad I stayed out of that one. So, you know, again, like I really wanted to, you know, like let you guys know about risk management is your number one thing. You're risking 2%. And here's another thing. If you have 2%, right? Let's say you did a 20 pip stop loss and then your trade started going your way, right? You got in here, stop loss was 20 pips and the trade is going your way. Awesome. Now, until you move your stop loss in front, right? And you make sure that you can't lose, then you can go ahead and reuse this 2%. It doesn't mean, oh, let me use 2% on EG. Let me use 2% on, you know, GBP US dollar. Let me use 2% on gold. So now all three of them went against you and you just lost 3 trades. So now you got to go ahead and completely reset this whole thing. Because remember, like it's 3 trades that you're allowed to lose without resetting this formula. So for example, if you lose $2 3 times, you're going to have $6, so you'd be left with 94. At that point, after you lost 3 trades, you want to go ahead and reconfigure your formula. Now you're going to do the 94 into your 0.02. So in essence, if you stick to this, you cannot screw up. All right, that's what I'm trying to really dig into your brain here today. If you really stick to this formula, whatever your total amount of dollars that you have in that account into the 0.2%, you cannot wipe your account. All right, because trust me, I've seen a lot of horror stories. This is not the only group I'm in. I'm in like 2 other groups. It's 3 groups total, and you got to see the horror stories I hear. It's crazy. And you know, we tell everybody when they're new, follow a good risk management plan. You know, so you're always shooting for 1 to 3 risk to reward or more, right? So the other day, actually this morning, I'll kind of show you this trade. Let's see.
I just want to quickly interject.
Yeah,
Correcting your math, that should be times 0.02, not divided by.
Oh yes, I'm sorry. Times. Yeah, sorry. Yeah. I'm sorry. I'm actually dividing the 2 into the amount the amount of sorry, you're right.
There you go.
It is
Yeah.
times, and then you divide the dollar amount into the amount of the slots that you're trying to use in order to get this 20 pip stop loss. You see what I mean? So you're dividing that into the 10 cent to get the 20 pip stop loss. Yeah, you're right. So it's a multiplication here and a division here. Sorry, I had it in the wrong place. I put a multiplication here, which is not. Yeah, it's not. You're right. It's the opposite. But yeah, the next thing I want to let you guys know also is, you know, understand that, you know, 3 trades in a row, you still have enough margin to come back and negate the loss, utilizing this risk to reward. So this is the most important part, the risk to reward. So let's say you're risking 20 pips for maybe like 200 pips if you're trading gold, for example, right? Gold can do 200 pips in a, you know, gold can fart and make 200 pips. So yeah, that's yeah. So, you know, like your risk to reward there is, you know, it's excellent. So, you know, you want to make sure, and then you'll come back from 3 losses very fast, right? So if you lose 3 times, right, you want to go ahead and redo your whole formula, and that's a multiplication. So 94 times 0.02, and that'll give you the new dollar amount that you can risk, right? And again, a lot of us will have $1,000 account. So yeah, you can still do 20 pip stop loss, but now you'll have like a 0.10, which will be $1 a pip. Now it's a whole different story, right? Now for every movement of a pip, you're making $1. So if the account moves 200 pips, now you've got yourself, $200. So, again, exponentially you're building your account, right? And then so if you like let's say you lose 2 trades, don't get all crazy about it. You lost 2 trades, so what? Guys, I've been doing this for a year now, you know, and you know, I lose 3 trades every other week. I mean, there's nothing you can do about it. I had a loss today on GU. It was going up nicely and I had profit. I did actually take out 30% like I always do. So remember, my is once it goes up 30 pips, I'm taking out 30%. So 30 pips, I'm taking out 30%. And then after that, if it goes up to about 75 pips, usually I'll take out another 30. And then after 100 pips, I'll take out another 30, and then the rest will be a runner. So I did make something, right? Because you've got to pay yourself first. That's one thing I always tell you guys. Pay yourself first, right? So I made some money, but I had a loss because it came back on me, right? And I didn't move my stop loss, you see? That's where I messed up. What I usually do is once it moves 30 pips, I move my stop loss in front, and then I go ahead and I take my 30%, right? But I did my 30% and then I got preoccupied doing some other stuff. There you go. You know, it came back on me and I lost the 30% that I made. So it was kind of stupid, but you know, hey, you know, sometimes there's days where we're all a little retarded. So today it was my day. So yeah, yeah. The 30% I actually cashed out. I lost it right back. But it was, you could call it a break even. But to me, I consider it a loss because I didn't make anything. I wasted freaking time on GU. Once Trump opened his mouth, bang, that's it. It was gone as quick as it came. So, you know, like everybody loses trades, guys. You know, if somebody tells you they don't lose a trade, put a polygraph on him. I can guarantee he's gonna lose that one. I mean, that's BS. Everybody loses trades. All right. So, you know, again, if you lose 2 trades in a row, no sweat. If you win your 3rd one, you're going to actually be in higher profit than the 2 trades you lost. Capiche? So you're basically, you know, by your risk to reward, even if you just get a 1 to 3, by winning the 3rd trade, even though you've already lost 2, you actually are in profit by 1. You understand? That's why it's 3 to 1. So you lost your first trade, you lost $2. You lost your second trade, you lost $2. Your 3rd trade you won, you gained 6. So now you're actually +2. You understand how this works? Why it's so important to follow this? Because now you can lose 6 trades, win 4, and you're still going to be in profit. You're still going to be, you know, in lots of profit. So, you know, if you look at what we're trying to do here is we're trying to assess, you know, how it is that you can, you know, like literally like make this thing work for you. You know, a lot of us don't have $100 accounts, and that's a great thing because now if we have $1,000, it's the same exact thing. If you do the 2% at 0.02, you know, now you're talking about you have $20 that you can lose per trade. That's your risk to reward. You're risking $20, right, to gain. If you do at the bare minimum, right, your bare minimum, which is 1 to 3, right, your risk to reward 1 to 3. So literally, you're risking $20 to gain 60, right? So you can lose, like I said, you can lose 2 trades, and and listen, you're your own worst enemy. Every time your brain starts speaking to you, that 3rd person that says, you suck, you should quit. What are you doing here? Go get a job. You know, like, that's the thing you got to learn to say, shut up. You know, like, just, you know, like, you got to cut that out. That voice, that inner voice, you got to be in control of that because that negativity can really get to you. It can, you know, it can turn from that, from like, you suck, you're not going to make it in this thing, just go get a freaking job like everybody's telling you to do. That's the voice that's going to tell you after that, if the next conversation is going to be like, you know what? Get in there with $40, get in there with a 0.4, forget about the 0.2. Let's double it up because we're going to get this one. Don't worry about it. You know, that's the voice you got to tell, shut up, you know, like, you know, leave me alone. And that, once you learn to cut the negativity, you know, like it's going to work for you. Trust me. And then 2 trades lost, right? And then let's say the next one is also lost, 3 trades lost. That's not a problem. Don't sweat it. First of all, the first thing I would tell you is if you lose 3 trades in a row, right, back off, because that means literally you only lost $60. Your account is still at $940. I mean, who the heck cares if you lost $60? That's not going to make you or break you. So by following this particular formula, you're guaranteeing that you're not going to start biting your fingernails off the freaking bone. You know what I mean? So, you know, like that's why I say if you lost 3 trades in a row, you must reevaluate this formula and now take the 940 that you have left over, and you're going to multiply that by 0.02 and then use that new dollar amount, which I'll tell you right now what it is. So you want to use the new dollar amount. When you lose 3, you no longer want to stay at 1,000 because then you wipe your account a little bit quicker. So you want to, again, like I said, you're going to have more than 50 trades in this, which is a heck of a lot of trades, right? So now you're going to have $18.8. You can round it up. You can say 19, right? You know, I'd rather do that, round up and say 19 instead. So what the heck did I just do? There we go. All right, so you got $19 instead of 20. Is that going to kill you? No, come on, guys. It's $1. You drop down $1. Now, if you lose the next 3 trades, right, your account is actually going to drop to about $892. So that's when you want to take a step back and say, all right, my analysis is not good, right? My strategy is not good. Now you want to contact, someone and start to really, study. You want to study a good strategy, something that works. I'm going to mention a few people because I've seen them turn corners like crazy.
Hey, well, wait, you can't cross recruit for anything that's against Super EZ. Sorry. Like we can't.
Oh,
do that.
no. I'm mentioning, like, for example, like Allison, we've seen her go from the quiet person to now like posting all kinds of crazy money. Like, I'm so proud of her, like Andre, same thing. He was pretty quiet. He started doing his own strategy, and now look at him go. I mean, he's holding trades for months. I mean, this is what you gotta understand, guys. Everybody feels like they're in a deserted island by themselves, and that they're the only ones that went through this problem or are going through this problem. That it's just them, and it's not like that. All of us went through this. So you need to dedicate your time to studying, and then you got to dedicate your time to getting this formula down. Once you get this formula down, and you make sure you stick to this, because that's the biggest thing. Once your strategy is good and you start doing this, you get into one trade, right? Your trade starts going your way. You got in here, stop loss is all the way up here, right? You want to make sure your stop loss is bought in front, and then you can go ahead and reuse this 2%. Until you've done this, you have no business in going for another trade. I don't care how good it looks. I don't care if it looks better than this trade, then you shouldn't have gotten into this trade to begin with. You know what I mean? So
That's really good advice. Yeah.
Yeah, I mean, it's like I've seen guys jump from like I got UCAD. Oh my God, look at gold. Oh my God, look at it. Like, relax. Don't drink too much coffee. Like, chill out. Yeah, like literally, you've got 0.2% to use per trade in a given day. Until you set your stop loss in front of your entry, you have no business to continue to go ahead and use that. Once this is done, then you can go ahead.
Let's take a break real quick and see. First off, does anybody have any questions on the stuff that's said so far? I know for some people it's rather elementary, and I know that for some people, I can see you taking notes in the chat, which is stinking awesome. So we're all in different places, in all fairness, and we get that. So for the people who this is helping, or you haven't heard this before, as simplistic as it sounds, please do step up. What are your questions? You can put them in the chat on YouTube or the chat on whatever this is, Zoom, whatever it may be. And there is no question too small. And secondly, like, is there anything that was not covered? Like, do you guys have any other specific questions for me, or specific questions for for Mr. Rich over here that may be able to help you to your next step. And the third thing I'm going to say, while you guys take your ever sweet time to, come up with the questions, because we know that takes some time, is this. Keep in mind that when I talk in class in the morning, when Uncle P talks, some of us are really good at recognizing that every one of these ways of thinking and ways of trading is all very individual. So at the end of the day, it's still an individual experience. And the thing that Rich said that was really dead on is we all kind of feel like we're in our offices or tucked in our little closet or wherever it may be, and we're on our own in this thought process. We're on our own in this losing experience or this winning one, and that's not easy or always fun. So just know that there are other people who are taking comparable journeys and comparable things at the just maybe different stages of that journey. So that's, I think, was a really good point that he made. So first question is, Hobbs said, what time frame is he using for a 20 to 25 pip stop loss?
A 4 hour. I use the 4 hour and the 1 hour. Now, my advice to you is this. I'll give you an example of why I use the 4 hour and the 1 hour. On the 4 hour, right? We might see this, right? We might see this here, really long wick, and another one, right? This is the 4 hour, right? But if you drop down to the 1 hour, this is actually a good pattern, by the way.
That's a tweezer top, yeah.
Yep. This here is an amazing institutional. This is what they call a institutional pattern. So this is our what's called PI, a point of interest. POI, sorry, POI. Why is this a point of interest? Because these normally have to be more than 10 pips, so plus 10, right? What does this signify? It means that the market makers are actually creating huge turnarounds, right? Because like usually you'll have smaller candles leading up to this, right? And then you'll have this huge candle north and then a huge candle south with these two tops. This is an incredible pattern. Now, what might this look like on a 1 hour? On a 1 hour, it may look like this.
That's a railroad top.
Yes. This is, yeah, it's a railroad pattern, exactly. But this is exactly what this pattern may look like.
Or an M formation.
Correct. So you always want to double check. Yes, the 4 hour is awesome. And if you already know what this is, you don't have to worry about going down. But I'd rather check both just to make sure, like I'm not drunk. Like, let's use that word, right? I want to make sure I'm not drunk one day and I'm like over here, like thinking, oh yeah, I know what this is. And then all of a sudden I don't check the 1 hour time frame and I'm wrong. And then it starts going north, right? If I'm trying to go south. So if I check down on the 1 hour and I see this pattern, right? And I see the retest, right? A small retest here, and then another quick dip, I'm getting in this bad boy. This bad boy
Hey,
going
you
down.
keep it right there. I'm going to annotate real quick. So, well,
Sure.
if I could figure out how to annotate when I'm not, I know how. There we go. And I'm going to even try to do a straight line like Scott does. Let's see. Of course, it's pink. Oh, I lied. Totally not a straight line. But once it broke that M formation, that pattern, that leg, you were in.
Yes.
So in order for him to get a stop loss like that, just to answer the question, back to the questions real quick, is he would have to be trading tops. He's timing tops and timing bottoms. Oh, sorry, I cleared your drawing.
Yeah, that's cool. That's cool.
But there's no other way to get that tight of a stop loss on that time frame. I mean, adequately, unless you're trading in a massively slow moving pair. So that's like timing tops or possibly dropping down to like the smaller time frames. So
Right.
next question was, what's a good spread to have before taking a trade? The spreads vary from broker to broker and person to person and even country to country. So
Yes.
you have to know that fixed spreads brokers typically have higher fees. And then sometimes brokers with higher spreads have no fees. But at the end of the day, and I know no one wants to hear this, it all comes out in the wash. Like for the most part, you can have the best broker with no spread and they kick your butt in fees. You can have the broker with the higher spreads, but then there's no swaps, no commissions, no nothing, even if you held it for a month. So yeah, in the Super EZ group, we talk about Hugo's Way and AFX primarily. If you don't have a link, there's one in the YouTube chat and there's one in every chat also. But keep in mind, London has lower spread, New York has lower spread, Asian and any crossover has a higher spread. So you shouldn't be taking a trade during that the session break. So when New York closes, our time, stay out of the market. And obviously the brokers hold the right to, widen the spreads based off of news. Some brokers do it more so than others. And again, that's variable information based off of person to person. So just know that if even in London session, if so-and-so speaks, they could widen that spread exponentially. In New York, our chairman spoke and they widened the spread massively just to accommodate for that. So that's, I don't think, a individual question. And then to get to some of the YouTube questions, this person said, so A times 0.02 equals the number of stop loss and pips. Actually, A times point whatever. So A is your account balance times point whatever percentage you want to risk equals, okay, what your stop loss would be. And that's what he's teaching, right?
Yes.
So
Guys, the thing about time frame, this is another thing that I wanted to before I used to be on my charts 24/7. That was the stupidest thing I've ever done. I know a lot of you guys are in front of your charts, multiple hours of the day. You could stand there, you can stand there, hold your breath and turn purple, blue, pink. I don't care. It's not gonna help. Okay? London, 3:45 a.m. to 8 a.m. That's it. New York, 9:45 a.m. Not 9. Maybe for indices, 9:30. But let's keep a note of that. For indices, 9:30. That's the key time. That's when Wall Street, I wish I had the bell. Ding, 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 ding. All right, that's 9:30, all right? So that's for indices. But for everything else, it's going to be 9:45 to 11. If you haven't found a trade in these two scopes of time, tomorrow, bye. Simple.
hey, Rich, you do realize that the highest volume is technically between like that window you say not to, so 8 a.m. and 9:45. That's the New York and London crossover. There's like a lot of volume in the market right then.
Yes, and a lot of times, most of those times you get reversal, so you got to be very, very careful with what you do there. So
True.
like from 8 a.m. to 9:45, you might see a pattern, for example, like this, and then it starts to go, and then all of a sudden you'll get a spike up, a spike down, and then it'll come back to set up for New York. All right, because remember 3:45 we were here and we took this trade and we were like, woo, great. But then 8 to 9:45 they did this. They came up, set you up, right? Gave you a supposed freebie, retested, spiked high, spiked low, and then came back up and took you out. So these gaps are the ones that I don't mess around with, and I learned it the hard way. I learned it the hard way because, like the gaps are where you gotta understand one thing. Okay, let me break it down to you this way. It's very simple. This is where we lose as traders. We have the human factor. Okay, you gotta eat, you gotta sleep, you gotta use the toilet, you gotta take your kids to school, you gotta pay attention to your wife, you gotta pay bills, we have 3 different market makers that take shifts like in multiple times on the world. Now this I learned firsthand in Wall Street. The market makers, the first market maker will come in at 2:30 and start messing with everything, along with the market maker that's already been there for 8 hours. And they start messing around with everything, trying to confuse the crap out of you. And then at 3:45 is when they finally stop messing around, trying to trick people, right? Because this is what they do. They see how many contract highs they got and how many contract lows they got. And that's when they're consolidating, right? They got you in this, hot zone pattern, right? And then you're thinking, oh, I'm going to trade down. Oh, I'm going to trade down again. Oh, I'm going to trade down again. And all of a sudden you get this fake out and boom, they come out. This happens around 3 a.m., right? So why does this happen? Because the new market maker took over. So they're always fresh. You're not. You stood up, all night long and you you try to take a trade at 3 a.m. and they destroy you. They just like, they killed you. Why? Because you're not fresh. You stayed up all night, right? But they're not. The new guy comes in and he says, what orders do we have? All right, let me take a look at it. And they take their book and they check and they destroy you because they know which way you're pointing, right? And what they want to do is they want to take out where the majority of the contracts are. So if we have 1 mil on high and then we've got 3 mil on going short, they're going to take out, the 3 mil. So instead of doing this high, what they're going to do is they're going to go ahead and they're going to do the total opposite, which is literally to spike low with a fake on and then go high. Why? Because you got 3 million in contracts here, and then they're going to take you out first. You understand? Because these guys are all going short, whereas we only have 1 million going long. So they'd rather give these guys the opportunity and take you 3 million guys out because there's more contracts there. So you got to understand the time frames are very important. And if you don't believe me, you don't have, like I said, I never believe anything anybody tells me. You got to go look for it yourself, right? Never trust. Always, never assume, never trust, always research. So research these times that you see up on the screen right now. 9:30 is for indices. So I would say 11 a.m. is the same. Research this.
Well,
And if I'm lying, I'm dying.
9:30 we try to avoid because it always spikes one direction, but we don't want to be part of
Yes.
the spike.
Yeah. So 9:30 is more for the indices because that's when Wall Street starts kicking it up. 9 o'clock Wall Street opens for indices, but 9:30 is when they really start heading the direction that they have intended to head from the very beginning.
Okay.
And again, keep that in mind. This is why these times are so important because you want to be fresh. You don't want to have your mind groggy, like literally like if you're drunk. Today, the subject has been drunk. If you're like, sleep deprived drunk, you're not going to function right. You're going to make a mistake. So that's why I wake up for this, right? I stay awake for this. I take a nap, go to the gym, check out, Asian. A lot of people don't trade Asian because, Asian is from, I would say 6. Do not mess with Asian at 5 because the spreads are astronomical. I had a spread on gold one time for $55. 55 pips, I'm sorry, if you believe that. One time I saw it. I couldn't believe it, but yes, it was there. So 6 p.m., you might want to take a quick look and see what they're doing, but usually Asian is the consolidation. I'm going to clear this, guys. Take
And
a
real quick,
snapshot.
we've got one more question too, and then we're about at the top of the hour.
Yeah.
But thank you so much for volunteering to come on here and hang out. So actually, we had a couple questions coming in. So first one is the time frame. The broker time frame is different. Again, that's variable. So believe it or not, they're not all the same. But in general, it's considered UTC. If I'm saying that right, I'm sure Scott can verify. But it's trader time is different. So it is not based on Eastern Standard Time. Everything we've discussed today is to Eastern Standard Time. He's in New York. So
New York City. Yeah, right here.
is the minimum risk and reward determined on where you see your trade going based on structure or based on something else? So he was talking about the math of it, right? But I'm going to interject that ultimately you still have to base it on structure. And if you're not, you're setting yourself up. So ultimately you should be able to see a basic target based off of structure and a basic stop loss based off of structure. And that's just being able to be technically proficient, no matter what strategy you use, no matter whether you're doing anything in the market. That is the fundamental basics, is to be able to estimate, and that is a guesstimate, and that is prediction, an approximate target, so a potential next zone it can be going to, based off of trend lines, based off of higher support, based off of previous, different time frames and where market has stopped. And you should be able to pick your stop loss based off of the previous high or the previous low, or wherever, again, price has stopped and made a violent rejection kind of mentality. So, but that's about it. Real quick to kind of wrap it up. I think that's all on YouTube as well. We'll let Mr. Rich draw this one more thing and kind of get a good idea.
So your structure should be based on liquidity. So for example, if I'm here, right, and I want to trade down, right, obviously, the market broke liquidity here, right? It swiped all of this liquidity. It's going down because it's got no business going any higher, right? So you want to go ahead and get in. But now, let's say you're watching this and you started watching it here, right? And you're like, okay, where do I get in? So now you're trying to figure what risk to reward you're going to take, right? So you're going to say, okay, you know what? I'm going to wait. So you watch the market. You're looking at this liquidity swipe. It already took it out. So now you know the market's on a downward move. So you look at this, and then it starts to make an M, and then it goes down. So now you see this liquidity here, right? You see, let's say, an institutional candle here. So you know this is liquidity here, right? There's a lot of money sitting here because people have their stop losses or pendings all sitting here. So your target would be for this to break this liquidity, and then you get in on the turnaround. And the turnaround, if you see liquidity on top as well, so you've seen, let me see if I can get a different color here. If you've seen liquidity here, right, where you got in, it broke it already, and you know that there's liquidity up here that has not been touched yet, then you can set your risk to reward based on the liquidity that's sitting up here. That's another way to look at it. You know, that's one of my strategies as well. So whatever liquidity, wherever you see liquidity that has not been swiped, where people, you know, people have stop losses, you know, people have pendings, that's where you want to aim for. So you don't want to, you know, you don't want to say, awesome, I got in here. Yay, woohoo, the market is starting to go up. Awesome. I'm going to go for 300 pips. How do you know? You don't. So what you want to do is you want to take your measuring tool, right? And you want to go ahead and measure just slightly above the highest peak here that has not been taken out by any price action. And that's what your target will be. That's how you know, oh, okay, so I'm risking 20. And when you take your measuring tool and you measure from here to here, this is, let's say, hypothetically speaking, this is 90 pips, right? So you're risking 20 to make 90. That's actually a pretty decent, you know, risk to reward, you know, just like that. So look for liquidity. Look for pockets of liquidity that have not been taken out by price action.
That is well said. All right, guys. Well, that's about it for tonight. We're at the top of the hour, so we're trying to keep the beginners classes much shorter than the morning sessions. Does anybody else have any pressing comments, questions, or things they want to add to the stuff that Rich kind of went over tonight? Let's see. I'm checking both of them. I actually get to watch YouTube today. This is fun. Well, a little bit fun, maybe. Donna should be in charge of this. That's it. She's in trouble. All right, guys. Well, in that case, well, thank you so much, Rich, for kind of going over all this. I think it's really necessary and important information. Again, individual in many respects, but still different strokes, different folks, different strokes, or however you say that sentence. It's still really good information. So please keep in mind some of the stuff in terms of knowing how to risk your account. It's all fun and games to go high risk, but it's not fun and games when you can't afford to reload your account. So only go high risk when you can afford to. Obviously, finding a better stop loss and knowing a good target is important, and risk to reward is probably something that most people get wrong right off the bat. So definitely valuable information. Thank you so much, Rich. I super appreciate you.
Appreciate you guys. Stay disciplined, all right?
Yes, sir. All right, guys. Well, I hope you guys all have an amazing night. Please give Rich a shout out and say thank you so much. We super appreciate you. And I will see you guys on Thursday morning if you're part of the advanced group. Otherwise, we'll see you in a couple of weeks with the beginners class. So have a good night, guys.
Thank you.
Thank
All right,
you.
you guys have a good one.
You too. Thank you, guys.
Thank you.